Guys, it's Stock Curry, and we just got some economic news that's pointing to a major red flag for both the economy and the stock market. So in today's video, I'm going to explain what that news is and how it affects you so that you're not stuck holding call options if the market reverses. So let's get into it! This week is the first week that we've had major economic news since the Fed meeting a few weeks ago. So I'm going to go over the news that just came out today, and then I'm going to explain what news we have coming up on Thursday and Friday, and then finally I'm going to go over some technical analysis and show you how both the news and the technicals are all pointing to a reversal in the stock market and a continuation of the downtrend that started in January. The news we got today that points to a major red flag in the economy is the home price growth as indicated by the Case-Shiller Index. The Case-Shiller Index rose 19.2% year over year in February as the inventory of homes fell and sale prices rose to new highs. Now, you've heard me talk a lot on this channel about the Cpi Index coming in at around 8%. The Consumer Price Index, or CPI, really focuses on the prices that consumers pay for certain goods and services. And based upon that, you're looking at about an 8% year-over-year increase. The problem is the CPI numbers do not exclude the two biggest factors of inflation in the economy, and those are the housing market and the stock market. And both the housing market and the stock market were up significantly higher than 8% year over year. So taking a look at housing prices first, housing prices did not go up 8% year over year. They went up 19% year over year. And this, of course, is due to the record low level of homes available. In fact, the inventory of homes for sale is the lowest it has ever been since the National Association of Realtors began tracking total existing home inventory in 1999, more than 20 years ago. Now, what all of this means is that there are bidding wars for many of the houses available for sale, which means people are paying significantly more than the asking price on houses, and in turn, they're paying a lot more than the appraisal values as well. And what this is causing is people are almost upside down. I mean, they're not quite upside down because they do have a little bit of a down payment, but they're almost upside down on these houses. Now, if housing prices fall even a little bit, 5–10%, a lot of people are going to be upside down on their homes. Now, when was the last time people were upside down in their homes? Well, the answer is 2007 and 2008. That's the last time people were upside down in their homes, and we all saw what happened in the housing market when that happened. Also, we saw what happened to the stock market when that happened. It actually caused the Great Recession. Now, I know a lot of people are going to say, but Scott, this time is different. It's not like 2007. Back then, we had all these subprime mortgages that caused people to be upside down. It's not like that this time. Now, the thing is, even though it's different, it's always going to be different. There's always going to be different causes for a recession or different causes for a bear market. Regardless, all of the recessions and all the bear markets are going to have certain similarities. And that just was what makes a bear market or recession a recession. So it's important not to get all caught up on the differences and the reasons why a recession or bear market might start. It's far more important to focus on the similarities so that we can learn from history, so that we can not repeat the mistakes of the past, and we can actually trade on the opportunities that are available in the market. So what opportunities does the mortgage market give us for the stock market? Well, the first thing that's going to be really important to understand is as mortgage rates rise, as the Fed increases interest rates and mortgage rates rise, fewer and fewer people are going to be able to afford homes. Now, as the affordability of homes decreases, that is going to decrease the demand or the buying pressure on homes. As demand goes down, that is going to lower prices. As prices go down, that is going to cause people to become upside down in their homes, and they're going to be unable to sell their homes. That's going to cause foreclosures to increase. That's going to cause a lot of banks to be out of a lot of money, and it is going to essentially cause a financial crisis 2.0 or 2008 2.0. It's not going to happen right away. So if you go back and you look at what happened in 2004, 2005, when home prices first started becoming overvalued, they didn't stop becoming overvalued until 2009. It took a full 5 years for housing prices to go from overvalued back to normal rates. So if housing prices just started becoming overvalued in 2021, we may not see housing prices settle down until 2026. We could be in for a very long, difficult time in the economy before things finally settle down. So while the rise in housing prices and the overvalue of the housing market is not going to have an immediate effect on the stock market, just like it did not have an immediate effect on the stock market in 2005, just know that it will eventually have an effect on the stock market. As people become upside down these houses, they hit foreclosures, they lose value, they're going to start pulling their money out of the stock market in order to take care of their financial investments in real estate. And that's going to cause the stock market to start coming back down. But it's probably not going to happen for another 2 to 3 years. So we're looking at a downward catalyst in the stock market starting in around 2025, 2026. Now, the other thing that's pointing to a major red flag for both the economy and the stock market is the 2-year, 10-year Treasury yield curve. Now, the way this works is essentially anytime the 10-year Treasury minus the 2-year Treasury becomes negative, 100% of the time, that points to a recession in the stock market going all the way back to 1955. Now, earlier we saw the 5-year and 30-year invert, but that has not been quite as accurate as the 2-year, 10-year. The 2-year, 10-year is the only one that is 100% accurate. Now, earlier today, intraday, the 10-year, 2-year Treasury yield curve inverted, meaning it went below zero. But where did it close today? At a low 0.06. It's literally about as close as you can get to negative as you can possibly get without actually being negative. I thought that the 10-year, 2-year yield would not invert until the first week of April, but at this point, it might actually happen in March. So we'll see. Sometime in the next few days, this thing is going to invert. And what does that mean? 100% of the time when this inverts, we get a recession. Now, most of the time, the recession will start sometime in the next 12 to 18 months. No earlier than 12 months, no later than 18 months. So that means somewhere between April 2023 and October 2024. Now, there's one time where it actually started in 7 months, and there's another time where it started in about 25 months. But outside of those two outliers, all of the other recessions started in somewhere between 12 and 18 months. So we're looking at somewhere between April and October of next year, a recession will start. Now, here's the thing about a recession. A recession is defined as 2 quarters of negative real GDP growth. Now, real GDP is the GDP minus inflation. So if inflation becomes super hot, that could cause the recession sooner, but it's going to be more of a paper recession than a real recession because GDP growth could still be strong. Regardless, this isn't really something you need to worry about right away because we probably won't get a recession for at least 12 more months. Now, the thing is, it's going to take 6 months before we even know we're in a recession because we have to have 2 quarters of negative GDP growth before we even know we're in a recession. So we're going to be in the recession for 6 months before we know it, which means even if the recession starts in April 2023, we're not even going to know it started until October of 2023. And if the recession starts in October 2023, we're not even going to know the recession started until April of 2024. So we're not going to know this for a long time. Now, here's the really important thing and how this affects the stock market. The Federal Reserve right now is trying to fight inflation. They're trying to stop either stagflation or hyperinflation from occurring. Now, what they're going to do is they're going to continue to raise interest rates, and they will continue to raise interest rates so long as inflation remains hot, that is above 2%. Now, the thing is, once a recession officially starts, the Fed is immediately going to stop raising interest rates. They're going to reverse, and they're going to start lowering interest rates. Now, typically what happens is over that long period of time where the Fed is raising interest rates, the stock market will actually fall during that time period. And then the moment the Fed stops raising interest rates, the stock market will immediately rebound and start going back up. So the moment that we know for sure we're in a recession, that is when the Fed will stop raising interest rates, they'll start lowering them. And that is the moment the stock market will stop going down, it will rebound, it will skyrocket upward. So that is going to be great news. But again, we're still a year to 2 years out from that actually occurring. So what about in the short term? Well, in the short term, the stock market could hit new all-time highs. It's actually happened multiple times after the yield curve inverted. There's a good chance we could get new all-time highs. But if we take a look at the technicals, it doesn't look like it's going to happen anytime soon. So let's go into the technicals and I'll kind of explain what I mean there. So to help explain this, I'm going to use the QQQ, which is a NASDAQ 100 ETF. Now the QQQ formed a hanging man candle, which kind of looks like a little hammer if you were to look at it. And this is a strong reversal candle. If you do any sort of technical analysis, you look at candlestick patterns, this is a reversal candle. In addition to that, it also left a gap that needs to be filled. So that's another signal that we're going to reverse and go down and fill that gap. And in addition to that, we also hit the 61.8% Fibonacci retracement level. By the way, the 61.8% Fibonacci retracement level is where usually a stock, or in this case an ETF, will retrace before it tops out and then starts going back down again. So we have three technical indicators pointing to a reversal in the stock market starting on Wednesday. Now, if you follow me on Twitter, or if you're part of the Discord, you know that I opened a QQQ vertical put spread on Monday, expecting the QQQ, or the NASDAQ 100, to either trade flat or slightly up on Tuesday. And in fact, that's exactly what we saw happen today. Now, earlier, before we got the massive rise up, when the NASDAQ was only up about 0.6%, it looked like we were going to turn bearish. I was seeing a doji candle starting to form on the daily chart, which is also a reversal candle. It really caused a lot of concern for me, so I closed out of that position for a 30% profit. Now, if you guys want to make 30% overnight, and you guys want to know everything I buy and sell before I actually place the trades, you can join the VIP Discord. In the VIP Discord, I post all my trades before they're actually filled. I also explain why I am placing those trades so that you can join in on the trades too. So if you want to make 30% overnight like I did, come join the VIP Discord. You can sign up at stockcurry.vip/getvip. Now, in addition to closing that out, when the NASDAQ hit that 61.8% Fibonacci retracement level later in the day, I opened a vertical put spread on the NASDAQ in order to take advantage of the QQQ, the NASDAQ 100 ETF, going down on Thursday and Friday and possibly Wednesday. Now, why might that happen? Well, in addition to the technicals and those three technical indicators pointing to a reversal in the NASDAQ and a continued downtrend, we also have some economic news coming out on Wednesday, Thursday, and Friday. Now, Wednesday, we have the ADP jobs report. Now, this is a private payrolls report. It's not paid attention to too much, but it might give a little bit of an indicator as to what might happen on the Friday jobs report, which I'll get to in 1 second. Now, Thursday, we have some very important economic news come out, and that is the Consumer Spending Index. Now, the thing about consumer spending is this is the Federal Reserve's preferred measure of inflation. While the news and the channel really focuses on CPI, or Consumer Price Index, it's really the consumer spending on goods and services that the Fed really focuses on for inflation. So if this comes in hotter than expected, we could see the stock market go down quite a bit on Thursday. And then on Friday, we have some more really important economic news, and that is the February jobs report. Now, the unemployment rate is already significantly low, so we don't really care about how many jobs are added or lost. What everybody's really going to be looking at is the wage growth. Now, economists are expecting wage growth to be 0.4% month over month, but if wage growth comes in higher than inflation, remember inflation was 0.8% month over month. If wage growth comes in higher than 0.8%, that could signal a wage growth spiral where inflation will continue to rise higher and higher and higher as wages continue to go higher and higher and higher. And as inflation goes higher, wages go higher. As wages go higher, inflation goes higher. And it causes this spiral where we end up in this hyperinflationary stage. So it's going to be very important to take a look at that wage growth in the jobs report numbers that come out on Friday. If they come in higher than 0.4%, that could cause the market to go down. And if they come in higher than 0.8%, that could cause the market to absolutely crash. So we really have to watch out for this economic news that's coming out on Wednesday, Thursday, and Friday, because it's all very important and it could make the markets go significantly down or significantly up. So it's going to be very important to watch this economic news coming out over the next few days. Alright, I hope you enjoyed that video and got a lot out of it. I wanted to present this information to you so that you didn't get stuck holding call options if the market reverses and starts going back down on Wednesday, Thursday, and Friday. Obviously, in the VIP Discord, we are trading multi-leg options, which will make money if the stock market either trades flat or goes down. So if you want to join those again, you can come join the VIP Discord where I post all those trade alerts. It's stockcurry.vip/getvip, and you can make the kind of profits you've seen me post in pretty much every single video every day. Now, also, I wanted to let you know that Tip Ranks is still offering their 30% off. If you want to get 30% off Tip Ranks, that promotion does run through the end of this month, so you got a few more days left on that. I have a link for the 30% off down in the description of this video. Finally, go ahead and comment down below any trades that you plan on making and how you think the market's going to go for the remainder of this week. And then finally, I just want to ask you, if you haven't done it already, please hit that like button and subscribe. And I hope you guys have a lot of success trading, and I will see you tomorrow.